Hey, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. It's September 15th. Let's start with the charts. Bonds are back up to where they opened. They're currently trading about 103.44, a lot better than what they were the day before yesterday. And we're at the kind of the top trading range of yesterday. So pretty good news for bonds. Our support's coming in below us, as you can see here on the green, at about 103.28 and 103.16, and our resistance is coming in above us at 103.50 and 103.59. So here's the reports. We got unemployment, the Philadelphia Fed, the PPI, not much impact there, Empire State, and the retail sales. Retail sales was a little helpful for bonds, but really just a mixed bag of news. Not going to get into it in too much detail today. But next week, the Fed is coming out, and they're going to either keep the short-term rate the same, or they're going to increase it probably. So not to say that they're probably going to increase it. I probably shouldn't have said it that way, but there is a chance that they're going to increase it. I really have a gut feeling they're not, but well, let's wait and see. They did talk like they were going to over the last week, which is why we saw the bond market fail as much as we did. To kind of quantify where you're at, Freddie Mac reported the average rate in August to be 3.44 at 0.5 points. We're about 26 basis points worse than that right now, which means the average consumer might be getting something similar but paying a little bit more for it, maybe closer to 3/4 of a point. Okay, source is Freddie Mac. Okay, let's get to the forecast. Pretty consistent neutral on short, meaning that both the analysts don't really think there's going to be much movement in the short term next 1 to 2 days. I agree with that. They are inconsistent on the long term. One of the analysts is saying, hey, it's going to be a little bit more flat trading, and he doesn't believe the Fed's going to come out and increase the short term rate. So he's maybe a little bit biased to going bullish on bonds. The other analyst, opposite. He's really bearish. He thinks that bonds are going to sell off and get worse. But I think we've already adjusted for the Fed to increase rate pretty well so far, probably 75%. So if the Fed does come out, increase the short-term rate, we'll see some sell-off. But I think we've already taken most of that impact on the chin already. So here's my bond range forecast. I think we're going to trade between 103.59 and 103.16, which means we are technically closer to the top end of that trading range. So until my next report comes out, I would say you have more risk than you do for losing money than gaining money. You might get an eighth better in fee if you wait. Probably a lot better if the Fed does not increase the short-term rate. But right now you're at risk to lose maybe 1/4 of a point in fee. So my bias is, hey, if you're going to go short-term, go ahead and lock it. I'm going to go with one of the analysts, and I'm going to say neutral. I don't think bonds are going to get worse up until the Fed meeting. I think they're going to stay pretty neutral. So that's my call. So if you have to lock in soon, I would say probably safer to lock in than not. But if you have the time and you really don't think the Fed's going to increase the short-term rate, float it. I think it's a little ballsy of a move, but I think you could see some pretty decent gains if you do it. So we'll see. Anyway, that's it for now, guys. Until the next report, would love to hear from you. Comments down below. And hey, everything likes to be liked. So does this video. You know what to do. And if it's your first time on the page, subscribe at the top left. This will keep you posted as market updates come out and what's happening with rates, if they're getting better, if they're getting worse. And if none of this made sense to you, like how do those charts really impact me as a consumer, it's okay. At the top right here, the little guy scratching his head, click that. That'll take you to Mortgage Bonds 101 and show you as a consumer how mortgage-backed securities impact the rate and the fee structure that you get when you're getting a 30-year fixed mortgage. That's it for now. We'll see you next week. Bye-bye.